Welcome to another course on Forex trading. My name is Iviwa Magoma. I am your Forex trading mentor and instructor. In today's tutorial, we're going to be talking about risk management. Risk management is very important in Forex trading. When you are trading without a proper risk management plan, chances of you growing your account are very small. Just like any other business, you need to implement proper risk management in your trading. You understand? So if you are running a business, you need to ensure that you are losing less and making more in your day-to-day trading. You understand? So I'll be jumping onto the Forex chart and basically making graphical representations of proper risk management implementation. So I'll be showing you how to place proper risk management when you are placing a trade. So yeah, let's jump on to the chart. Okay, cool. We're on our chart now, and let's say we found a nice setup that's on a resistance area that's just been broken and is now on retest. You understand? Wait, let me just find a horizontal line here. Let's say right here we found our entry in this area where we've placed our horizontal line, and you saw a nice bullish engulfing pattern, which indicates that the chart is now going to move in an upwards direction. But now with Forex, we always have to implement proper risk management, because we'll never know if the chart will actually move in our direction. So you see this bullish engulfing pattern and you figure, okay, cool, let's enter this trade and see what's going to happen. So now you have to implement proper risk. Now, in this process, I'm going to show you how to place proper risk and incorrect risk for this trade. Let's say you wanted to place a trade. This is a buy trade. So we enter this long position right on that engulfing pattern here. Now, in terms of proper risk management, it will actually be up to you if you are trading a one-to-one, meaning that you are risking one with the hopes of making twice the amount in this trade. You understand? So this would be a perfect example, of a one-to-one. Wait, this would be a perfect example of a one-to-one. So your gain in this case will be equal to the amount you are actually risking. I don't normally trade this risk reward ratios. I start from 1 to 2 or above. So let's say in this case you wanted to trade 1 to 2, meaning that you are willing to risk, let's say, $1 to actually gain $3 in this trade. You understand? Meaning that you'll make a profit of $2. You understand? Now let's look at this scenario. This is proper risk management, guys. Once you trade like this, it means that you are risking less with the aim of actually gaining more. Now, incorrect risk management, you might imagine now in this case, let's say you are not sure about the price. Let's say you are not sure about this support area that we're looking at. You think maybe it might break, and if it breaks, most likely it's going to come and retest on this area. So you want to take your profits right up in this area. So you think if price breaks, it will come and retest this area here. So you move your stop loss to a bigger level, because you are anticipating that price must come back here. So this is the size of your stop loss, and you are hoping to take profits at this level here. When we're looking at this trade, we can see this thing is incorrect. This is not correctly set, because if you actually end up losing this, how many trades do you have to win in order to make up for the money that you would have lost here? You understand? So this wouldn't make sense, meaning that you are putting greater risk than you are actually hoping to get out of this trade. Once you find yourself in a situation like that, that will not be an ideal trade for you. It's better for you to just step out of that trade and find a better one. Proper risk management is if you can see that, okay, you have faith in this support area, you don't think that price is going to break, or if it does break the support area, it must just stop you out and you can just go and find another trade. And basically you take profit. Basically in risk management, Risk management actually goes hand in hand with the type of strategy you are using. So if your strategy in this case was actually going to allow price to move like in um, this distance, you understand, so this is the amount that you would have made, and this is the type of risk management that you would have implemented. This is always great risk reward management. If you use this type of risk management, this is probably a 1 to 9. If you use this type of risk management, you actually stand to gain more from the forex market than you stand to lose, because what's going to happen is, as a trader, you will suffer some losses. Every trader suffers some losses, but the type of strategy determines your long-term profits. So if your strategy is most likely to win 40% of the time, and most likely to lose 60% of the time. If your risk management strategy is good, winning 40 of your trades out of 100 means that you are being profitable, because all the 60 that you've been losing, you will be losing less. Like, you would be losing just this amount, this small amount here. That's all that you'll be using. That's all that you'll be losing. Sorry about that. But out of all the winning trades, the 40 trades that you have been winning, you would be winning this whole amount. You'll see this distance from here to here. You'll be winning this 40 times. Just imagine, you'll make up for all your losses that you're making. So if you have a good strategy, good risk management plan, it's most likely that you'll actually make it far in the forex trading, in the forex industry. But if you have bad risk management, you won't last. You will just blow accounts over and over and over again. But as professionals, we do not take these much risks on the market. Some do, some don't. It depends on your strategy. In my case, I would take profits right about this area and basically wait for another entry. So I would wait for price to come to this area and basically hit this take profit target, and I would be exited, or I would be trailing my stop. If I'm exited in profits, I'll wait for another entry, maybe for a break and retest, then I'll enter again and basically ride this wave up, doing that thing over and over again. That's basically how I would go about trading. Or I would just if price hits a certain target, I'll just move my stop to break even. Now I know that now I stand nothing to lose. If price comes back in this area, it will just stop me out and I will have lost nothing. But if it continues in my direction, it means I would be gaining more from this trade. So that's basically how I implement my risk to reward ratio on my forex trading. I hope this made sense to you. I hope you found knowledge in the strategy. Now you know how to implement proper risk management in the forex market. So yeah, guys, that's it for today. I hope you enjoyed these lessons and have a great day. Goodbye.